You're listening to The Moose and the Loose, your 10 minutes action-packed financial podcast with your host, Mikey Hu. Hey, what's up, Market Moose? Mike from The Moose and the Loose. I hope you're doing well on this Business Friday. So today, AF Business, AF Investing or Retirement Planning, actually, I should say, because I am going to talk about what changes at retirement. I'm talking about this because you probably know that already, but I'm working on a new project for people about to retire or young retirees. So people in that transition, having a lot of questions, not knowing where to go, wanting to like build their own plan and to know like how to get into this dream of retiring, right? So you can register to the wait list at moosemarkets.com/retirement. So moosemarkets.com/retirement. You can register there and you're going to be the first one to know what's coming up. So you probably know that, but I used to be a financial planner. So I worked as a financial planner for 10 years at National Bank. So about half of it for in the branch and the other half as a private banker for private banking 1859, still at National Bank. And I had this opportunity to do hundreds of plans, meeting with hundreds, if it's not like 1,000 clients, to talk with them, help them through that transition, managing their portfolio, but a lot more than that too. So today we're going to talk about what changes at retirement from a perspective of investing. The first thing that changes is your mindset. And there is a lot to cover here. So the first thing is you go from accumulation phase to decumulation. So it sounds kind of like obvious, right? But the moment you stop adding capital to your portfolio and you start withdrawing money from that, and you have to accept that a part of your portfolio is likely going to go down because in general, we withdraw more money than what we will return. So the investment return is not enough to support retirement. And eventually, the whole goal of that, right, is to enjoy retirement, spend money, and enjoy life. But the first years of your retirement, you will have to change that mindset and accept that you are starting to withdraw money from your account instead of seeing your account going up. Of course, the most fortunate of us will not have that problem and they will just see their account going up forever because they withdraw more than what they need. But let's be honest, that's not going to be the case for most Canadians, right? The second thing is the urge for safer investments. And for that, I have a small story. When I was 35, I took a sabbatical year. I jumped in a small RV with my family, so my wife and 3 kids, and we drove across Central America. That was amazing. That was crazy. It was like the best year of my life, best decision I ever made. But on the other side, when I look back at this story today that I'm 43, I'm not even sure if I would do it again. In a sense where, man, that was scary. Like that was like there are like moments where we were in dangers and that was not super safe. And as you approach retirement, you may look at your investment and think, well, I made a lot of money on those companies, but today I don't want to hold those cowboys anymore, and I kind of like want to clean up that portfolio and go for something a little bit more boring, a little bit more safer, that will not give me like a heart attack whenever I look at it. Like yesterday I discussed Stella Jones going down 14%. Maybe you don't want that in your portfolio anymore. And the other mindset that is changing is tax optimization. So we focus so much on tax optimization that at one point, sometimes I think we just think of like a tax obsession. We want to save every single penny and we don't even think about the global picture. So sometimes I had clients that were saying, yeah, I don't want to suffer from OAS clawback. And I'm like, okay, if it's possible, that's great. But if you're getting OAS clawback, that also means that you're making like over $100,000 a year in income at retirement. You should celebrate, guy. Really, you should be happy. That's a great problem to have, right? So if we can do optimization, that's great, but let's not turn that into an obsession. So that's for the mindset. So accumulation from decumulation. the urge for safer investment and tax optimization over tax obsession. The second thing that is changing is, of course, the risk volatility tolerance. So a lot of investors are thinking, well, maybe I should change my asset allocation. And that's fair. There's a rule of thumb. You should have like your age, like the number 100 minus your age, and that should give you your exposure to equities, to the stock market. So right now I'm 43, so 100 minus 43, I should have 57% of my portfolio in stocks. I'm 100, so I guess it depends on your risk volatility, right? But again, because you want safer investments, because you don't want to like spend your night thinking about your portfolio, you might want to go into bonds, which is totally fine. It's totally fine as long as you have a plan. Because if you have a plan and you know that you can lower your expected returns, because that comes with it, right? If you're not in the stock market, if you're not buying growth companies, well, it also means that yes, your portfolio will be more stable, which is great, but it also means that you should not expect to generate the same return. So if your plan is to generate like 4 to 5% in total returns, so like interest, dividend, capital gains, well, that's fine because you don't need that much in terms of investment performance. So you can lower your exposure to the stock market and sleep better at night. So that would work. Another solution would be to lower that risk volatility tolerance is to have a cash reserve. And I talk about this all the time. And actually, I have a webinar that is coming up soon that we will discover how to optimize that cash reserve. So you can register it to moosemarkets.com/webinar. So pretty easy to remember, like moosemarkets.com/webinar. Having cash reserve will enable you to not be forced to sell during a down market. So whenever the market is down like 10-15%, you just take the money that you need to retire on that year from your cash reserve, and you let your stocks continue to generate some good dividend and to grow eventually and recover. Finally, so after the risk volatility tolerance and the mindset, we also tend to focus more on income. And I get that because the whole goal here is to create your paycheck, right? You stop working, so you stop having a paycheck, but you have a portfolio and you want to create another paycheck from it. A lot of investors will focus on high yield stocks. Some others will go for covered call ETFs or other high income products. We have the Yield Max, we have Canoe Income Fund. We have like plenty of, like, the industry is filled with income oriented products. Why? Because they want to fill that void. They want to answer your needs of creating a paycheck. But by doing this, you're making your life easier and simple. As I like to say, you do napkin calculation. So $1 million, 5%, $50,000, boom, you retire and you don't have to look at anything else. But it's just important to understand what you invest in and understand the dynamics. So the covered call ETF will only be good if the asset where you write the covered call on is doing great. Same thing with the Yield Max. So it's just to understand that, oh, my covered call ETF is going up like 10% this year. So it's all good and it's an amazing product. Yeah, it's normal because it is based on stocks that are probably up 15 to 20%. So I hope that you're making money. That makes sense. But when it goes down, you will also suffer. So you have to consider this before jumping into that. And in the end, how about you create your own paycheck instead? By a mix of quality companies and a cash reserve, you can decide to create your own paycheck. That's essentially what financial firms are doing for you. It's just that you don't see it. So they just tell you, buy this product, and at the end of the month or at the end of the quarter, you're going to receive $1,000 from us. And instead, you could just manage your portfolio, include high quality assets in it, and by the end of the month, just withdraw for $1,000 and create that paycheck. It works very, very well. And this is actually what I discuss in the webinar that I just talked to you about. That will be Dividend Income for Life on November 28th. All right, guys, I will be talking a little bit more about what changes at retirement and other teams, because there are like investment teams, there are planning teams, but there are also fun teams. We have to talk about traveling, staying healthy, having goals, having passion, having hobbies. There are like so many different things that we have to talk about when we move into retirement. And this is why I am creating a new retirement community that will be launched actually at the end of December. So it's coming up soon. If you want to be aware of that and be the first one to know what's going on, I'm going to start dripping some information in the coming weeks if you register to this special waitlist. So you can find it again at moosemarkets.com/retirement. Every week or so, I'm going to give you a little bit more information about that. And I hope that I will be able to help you move into that transition of retiring. All right, Moose, that's enough for today. Enjoy your weekend. We're going to talk again on Monday. And until then, don't forget to stay invested.
Hey, welcome to the disclaimer. If you're listening to The Moose and the Loose, you cannot really expect me to give you buy or sell recommendation or financial advice, right? You're here for fun, you're here for information and some entertainment. But I am not your financial advisor, I am not your broker, so therefore I'm not liable if you're losing money after listening to the podcast. If you're looking for some advice, go see a professional. If not, you can enjoy this show and do your due diligence after it.